Hello, this is Joe Viery with USTAGI, U.S. Tax Advisors Group Incorporated. Today, I'm going to talk a little bit about depreciation methods. The most common method is straight line. Straight line is very, very easy to calculate. Accountants do it every day. Building owners do it every day. And it's simple. You take your acquisition cost of the building, whatever you paid for the building, and you deduct the non-depreciable part of the asset, which is the land. So let's say you give yourself a land allocation of 20% and you buy a property for $100,000. That would give you a building basis of $80,000. To compute straight line, if it's a residential property, divide the $80,000 by 27 and a half, which will give you your depreciation expense for that current tax year, and will continue the same amount for 27 and a half years. If you have a commercial building, the commercial building life is 39 years. So take that 80,000 divided by 39, and you're going to have your depreciable expense for the next 39 years. What we do as a cost segregation company is we determine the correct way to depreciate a building. So for example, if you look down at the floor of a building and you see carpet, well, you know carpet's not going to last 39 years or 27 and a half years. The IRS recognizes that concept. So there are hundreds and hundreds of components of the building's construction that can fall into shorter life categories. The interior of the building most commonly is 5-year personal property and 7-year personal property. The land improvements is 15-year for land improvements. So what we do as engineers is we identify these components, and because they have shorter lives, you can accelerate your depreciation, and therefore you get a higher expense that you can deduct in the year that you file your taxes, and the higher expense will mean you're going to pay less income taxes. We are in a situation, a current year, where 2021 and 2022 is the last year for 100% bonus. So the way the bonus depreciation rules work is that any item component of the building that has a depreciable life of 20 years or less, you can expense that immediately, all of it, in the year that you apply your taxes. So that means if we find, for example, 20% of the building in 15-year and 5-year, you can take the 20% and expense it immediately the year that you file your taxes. Now, to be clear, you're still going to get the 80% on that example, which is your straight line, because that straight line is the calculation for the real property of the building. Well, that you'll continue to get. So when you do accelerated depreciation, you're not going to eliminate and take all of your depreciation in the tax year you do the acceleration. Rather, you're going to take only the personal property and the land improvements, and you're going to take that and accelerate it. And so bottom line is you'll have the rest of the building depreciated over the normal 27 and a half or 39 years life of the property. So that explains a little bit about the difference between these two approaches, and the value of accelerating your depreciation, which means you're going to pay less income taxes. So I ask you, who wouldn't want to pay less income taxes? Thanks for listening.